Okay. Well, like I said, welcome everybody. I, I always wonder how valuable these meetings are. I feel like it's the same 4 or 5 people that attend them, and so I'm hoping that means it's valuable to you. Um, and often wondering what we could offer in this meeting that would make it more valuable. So if you ever are thinking about it, and maybe it's kind of weird to speak up in the meeting, but you'd like to share something like that, I would not be offended at all if somebody emailed me and said, hey, it would make those meetings way more valuable, and shared that. So just know that I don't believe that I have a corner on what makes one of these meetings worth it or not to people, um, but I don't want to waste your time. So let me know if there's something that we're doing or not doing in these meetings that might be helpful. As far as general announcements this week, a little apology for me. It took me longer than I planned to provide some feedback on the rough drafts. Those are all graded now. Honestly, like I said before, I did try to provide feedback, but you'll notice I gave full credit. So even if my feedback seemed negative or not, or, it wasn't meant to be negative, it was meant to be helpful. So take that for what it's worth. And I told you before, it's one of those assignments. If you put effort, if you put effort into it, you're going to get full credit. So the same on the final draft. If you submit a final draft that has that you've written it out and made an effort, you're going to get full points on it. So what I'm saying is don't worry a bunch about it. And even if you felt like my feedback was critical of you or something, please don't think that you're going to get a bad grade or something on the final. That was just an opinion of someone who's been in the business a while, I guess, on some of those. Anthony, do you have something to say?
Can you hear me okay?
Yeah.
I just had a quick general question about, I guess, kind of that assignment, and this could just be not to, take away, or I don't want you to have to feel like trying to seek for a more clearer understanding or the exact answer, but I feel like something I might be struggling with, and maybe you can reference me to a chapter that I can study to, because I know it's kind of fundamental, but with even just that assignment, if we're given a word problem, I feel like something that the exams has done, it's I feel like made it challenging between the homework and the exam questions, is you'll get a word problem, and a lot of the assignments or a lot of the questions, you'll be given an example of an account or a transaction or something that will take place, and then you go down to the drop down and it's magazine expense or whatever, and so you'll know exactly, I mean, not exactly, but you have a good idea because you're okay, it was a magazine thing, and then there was a drop down. But I guess what would be your train of thought, or a good place to I guess better that skill of not knowing? Because I feel like a lot of the exam questions, I'd read it and just think I kind of know, but I don't. There's not a drop down here, so I have to. You know what I mean? I don't know. Do you have any thoughts on bettering that skill?
Yeah. So I will say, on this specific assignment, it's poorly written, and I've seen you're not privy to the instructors comments, and I'm on a little chat where we're trying to improve the course, and a bunch of instructors were like, this is just a poorly written question. So there's that issue. First of all, this question is not well written, and so it leaves you am I, the whole thing about it being 1/5 of the revenue, and so some people are like, do I take a fifth of it? And other people are like, no, I think it's for the whole year, so I think I divide it by 12. It doesn't provide that very clearly, and so
Even on sorry, I didn't mean to, even on the previous weeks, I've noticed as we've gotten in, I mean, I understand the fundamentals and stuff that has carried over, but it has seemed even maybe it was last week or the week before last homework, where it just kind of, we went from very basic, okay, we're going to record these 1 through 5 at a time, and then we'll look at it. But it seems even the last week or so, it's just been oh, and we know that goes to whatever the expense is, and the specific. And so I guess is there a trick or a specific chapter where I guess if it's not a general common stock or something like that, if it is a specific type of expense, should we just know that it's going to be that specific, magazine sales revenue or expense, and know to put that in front of it, and that it is, I don't know. I guess I feel like I got kind of lost in the last like week or two on those type questions.
Yeah. So the short answer is, in real life, we have a chart of accounts. In other words, you'll work for a new business, you'll have their chart of accounts. You can see what account names they use. Sometimes in word problems, the authors don't do a good job of saying, especially as it relates to revenues and expense accounts, because revenue and expense accounts are often just named something by the company. I worked with companies who call their cash accounts blue checkbook and green checkbook because that's their two checking accounts. And so there's like this learning curve when you get there, and then especially because you've never seen that, those were the colors of the checkbooks 5 years ago when they created the names, and now anyway. So for these types of problems, typically there will only be like one or two revenue accounts really in that it can be. I trying to think on the exam, I don't think there's ever like where you have to fill in the account name without a drop down, is there? Or was there? I thought there was still some, some choices that you were choosing
Yeah,
from.
there's the drop downs. Yeah, a lot of the drop downs, you're just like, oh, that's it for sure, because that's what the whole scenario is. But I did notice, like someone shared in the quiz, knew exactly. I think maybe it was one of the ones where it wasn't a drop down, but it's like where you go step by step. I don't know what that's called, how to differentiate the problems, but there's one where you do step by step, and you did. I think it was one where you were given all the different kinds of accounts, and you just kind of had to know. And it even seemed like it was one of the other teachers that one of their videos, and they were just, oh yeah, this is obviously this. I'm like, how did you just know to go straight to that account?
So I mean, other than experience with them and knowing that most expense accounts have expense after their name, that helps. And then usually those are obvious, but there's ones that aren't. And then like, most revenues accounts will, when I create them, I prefer to call them this sort of revenue, but you'll see some revenue accounts called fees earned or rents, rents earned instead of rent revenue. And so, I mean, there is no specific place in any chapter that I can think of that's going to tell you like, these are, the keywords that would indicate. I mean, but there are those, right? You start to learn anything with payable after its name is a liability, anything with receivables an asset. And so typically with revenues, you're going to see either revenue in its name, except for unearned revenue. That's a liability, right? That one's tricky. But like earned or sometimes like you'll just see sales, especially now when we get into the merchandising companies. But most companies call it sales revenue, but some just call it sales, or merchandise sales. Or so I don't have a secret like magic bullet, I guess, for it, other than it just comes with working with it. And if I ever do that, if I'm ever like, obviously it's this, like, you can feel free to be like, hey, it wasn't obvious to me, stupid, or don't call me stupid. I mean, you can, it won't hurt my feelings.
If I run across any other examples or anything like that, I'll be sure and shoot you a message on Canvas. I wish I should have brought it prepared, but I just got off work. So, but no, that makes sense. And I kind of felt that way generally about it. I wasn't, but yeah, maybe it was just because it was another teacher that was explaining it and they just like wrote it, yeah. So I'll make sure, and if I have any other examples of that, I'll
yeah, let me know. And like, for real though, like I never mean to like, I don't know, undercut somebody, be like, well, if surely you don't know what you're talking about because this is obvious. Like I don't want to be that guy, because what I've learned is the only thing that makes me the teacher in this class and not the student is that I just have more experience with this stuff, and that I could probably, there's probably plenty of things that any one of you could teach me, and I would be the guy who didn't know about it, and then and I don't like being at, it's hard to be in that position where like someone's teaching you, and like, I don't know, for me it requires a certain amount of humility that that I don't always have. It's hard for me to admit when I don't know stuff. Anyway, so I don't want to be that guy. So anyway, Okay, I'm talking more than I should about it, so I'll be done and move on. Um, so I guess back to like, just don't like worry, don't invest hours of time in the memo. Just take a look at what I put in my feedback and try to respond to that, and you'll be fine. You get 100% on it. Okay. Um, and if you're some of those lucky few that got like, this looks good, you don't have to change anything, then for real, just resubmit it as your final and then be happy. Unless you're like, no, I want to learn how to write a better thing, then you can talk to me and we'll do an hour-long meeting to go over the memo or something. Anyway, if you want to, I mean, like, I'd be willing. All right. Any other general questions about this week's stuff before I kind of get into a little bit of more specific material? Christy, I noticed you have like kids walking by, and you're like so awesome at just staying focused and not even like turning your head to look. I can't even sit like in the busy part of a restaurant. I just have to be moved to the corner. I can't handle people walking by me, so I'm impressed. That's mom skills. Uh, I'm sorry, I went up and stayed with my granddaughters this weekend, and like, I'm so used to having big kids only in the house that it's like exhausting to have children that like fly around.
Yeah, it can be.
Actually, I find my 17-year-old actually, he just turned 18 this weekend. I find him exhausting too. But we'll be getting him out the door in a couple months here, so that'll be good. I always get along better with my older children when they're on missions, because then I can just be proud of them instead of like, why do you want to sleep till noon? Like that. All right. Okay, so let's take a look at where is it? I had that open somewhere. There it is. Put it up over here. All right. And all right. Is everybody seeing that inventory system? It says participants can now see your screen. So I think that means you guys. Congratulations, you've been dubbed a participant. Nothing warms the heart better than that. Okay, so this section, this next couple chapters are about merchandising companies. Those are companies that instead of doing services, they sell stuff to people. So they buy stuff from a supplier and then they sell it to customers. And so some of the big changes we'll see in this chapter is the addition of what's called merchandise inventory on our balance sheet, which is an asset. That's the stuff that we sell to other people. And the addition of cost of goods sold to our income statement, which is an expense, which always seems kind of confusing, but really and truly it is just the cost of the goods that we sold. Like, so it's an expense. What's confusing about it is that when we buy the inventory, we hold it on our books as an asset, and then we don't calculate it as an expense or I guess claim it as an expense until we actually sell the stuff. So sometimes there's like this space of time between buying it and selling it where it can be a little confusing. And so we'll talk about that. So first of all, we need to know that there's two different types of inventory systems, and they're perpetual systems and periodic systems. Perpetual just means that we are updating our accounts with every transaction, as opposed to a periodic system where what we do is we just record the data of our sales for a period of time, and then we update at the end of that period. And so I'll tell you, I grew up in a business. My mother owned a store where we did a periodic system because we couldn't afford the computers and things it would take to do a perpetual system. If you think about it, perpetual systems are becoming more and more common because of the cost of computers and point of sale barcoding systems coming down. And so in a perpetual system, what you'll do is when you get a case of canned corn or something that you're going to sell, you'll go to the computer and you'll say add 32 and then quantity, and then scan the cans, and it'll add those to your inventory. And then when you sell it to the customer, you'll scan the can again and it will deduct that from your inventory. So that's happening updated on every transaction. In the periodic system, what we had to do when I was a kid is we had a notebook with a page for each item we sold, and we would record at the beginning of the year or the end of the previous year. We'd count up how many cans of corn were there and write it on the page, 12 cans. Then each time we made a purchase of cans, we would write that down, and we wouldn't keep track of the sales at all. And so then at the end of the year, we would count how many were there, and we would say, hey, what we had before plus everything we purchased minus what we have at the end of the year tells us how many we sold during the year. And so we would calculate our cost of goods sold that way. And I hated that job as a kid, walking around every single item that we sold in that store and counting it and writing down how many there were in a notebook. I think my mom paid me like $3.85 an hour for that. And I think that was child labor, but I guess that was how I was getting fed. So I should have been grateful, right? All right. So that's, I guess, the first term to recognize is the difference between perpetual systems and periodic systems. The next is that we have something called purchase discounts. Okay, so when we purchase goods from a supplier, we're called the purchaser. And when we sell goods to a customer, we're called the seller. And so a merchandising business fulfills both of those roles. Sometimes they're a purchaser and sometimes they're a seller. And it's really easy to get confused about that, but it's super important to know what role you're fulfilling so that you know which transaction to do. So when we purchase from a supplier, many suppliers will offer a discount if we pay for our purchases in a timely manner. And so you need to be comfortable with this notation. What I have up on the screen there, it says 2/10, N/30. And what that means is that you would get a 2% discount if you paid for your purchase within 10 days. And if you don't pay within 10 days, so starting on the 11th day, then you'll get no discount, but the net amount or the whole amount is due within 30 days. If you get past 30 days, now you're late. You didn't pay on time. Okay, so this notation is very common, very standard, and it'll be the discount percent, and then a slash, and then the discount period, or the amount of time you have to, I guess, take that discount, and then a comma, and then net, meaning the whole amount is due within 30 days. So this means a 2% discount is paid within 10 days. Whole amount is due within 30. You'll see 110 net 30, you'll see 115 net 30, 15 net 30, 15 net 60. So there's lots of different variations on this, but it's always done in the same notation, which is a purchase discount percent within a number of days. And if not, if you don't take the discount, then when the full amount is due. Okay. All right. So let's look at a couple of examples. Here's a purchase with a cash discount, and we are using what's called the gross method. Okay, so I'll kind of walk through these. So on November 2nd, the Z-Mart purchased $500 of merchandise inventory on account, and the credit terms were 210 net 30. So sometimes when we record these, we use what's called the net method, which means when we make our purchase, we're going to go ahead and record that merchandise increasing. That's an asset, so it's increasing. And the accounts payable, the amount we owe, also increasing. And we do it by the full amount. So businesses who use this gross method, what they do is they record the full cost of the merchandise. In other words, they're making this base assumption that they're not going to take that discount, that they're going to pay full price. So they go ahead and record the transaction at full price. Then if they do pay for it within the discount period, they're going to do this discount entry where now the accounts payable is going down because they're paying it off. The cash is only going to go down by $490 because they got the 2% discount. And then the credit here goes to merchandise inventory. Now that confuses people a little because they're like, why is it going to merchandise inventory? And the answer is because merchandise inventory represents the cost you paid for your merchandise. Okay. So remember on the previous transaction, we recorded merchandise inventory as costing us $500. But if we take the discount, our merchandise inventory really only cost us $490. So this credit to merchandise inventory is going to allow merchandise inventory to have a balance of $490, which is what we paid for it. For me, it gets confusing because I tend to think of merchandise inventory, probably because I grew up in a store, as like actual physical goods sitting on a shelf. But really what that account merchandise inventory means is the cost of those goods, not the actual like cans of corn that I'm selling or whatever. So, so that this first concept is called using the gross method. And in the gross method, we record the initial transaction at the full amount. And then if we take any discounts, we go ahead and do this entry when we pay for it to show that our accounts payable went down by the full 500 that we owed, but we only had to pay 490 in cash. And the difference, that $10, we're reducing from our merchandise inventory to show the reduced cost of our merchandise inventory. Again, if you have questions, jump in and ask. If I'm going too fast, let me know. And I will try to slow down and explain it differently. In the same transaction, if we didn't pay within the discount period, then our payment transaction would look like this: just our accounts payable going down, being debited, and our cash going down. And so when we use the gross method, we record everything at the full price. And then if we take the discount, we show the discount as a credit to merchandise inventory when we pay. If we don't take the discount, then we're just gonna pay it. We're gonna show the accounts payable going down and the cash going down. Okay, sometimes when we're the purchaser, we'll take what's called a purchase allowance. An allowance is issued to the purchaser. Let's see. For what's called defective goods. So in essence, what happens is sometimes you buy something from your supplier and then you get them and they're defective, or maybe a part of it's defective, right? Like, you know, you order, again, I'll go back to my case of canned corn again. And when you're stocking them on the shelves, you see that like 3 or 4 cans were dented or something like that, or maybe even one broke open and it's ruined. So you call your supplier and you say, hey, some of this merchandise was defective, and instead of them having you return it to them, because that's just a hassle and it costs a lot to return things, they just issue you what they call an allowance, which says, hey, we're going to take $30 off of what you owe us. Okay, we're going to give you a partial discount because some of the product was defective. So whenever we get one of these allowances, all we're going to do is reduce our accounts payable by $30, almost as if we paid it, and reduce our merchandise inventory by $30, because again, that's reducing the cost of that inventory to us. And then sometimes things are so defective, or maybe we just don't need them, that we will actually return them to the supplier. So you can see here, we purchased $250 of merchandise on June 1st with terms 210 net 60. That means a 2% discount if paid within 10 days, or the whole amount's due within 60 days. On June 3rd, we returned $50 of goods before paying the invoice. So then when we pay our invoice on June 11th and take the 2% discount, that discount will only be on the remaining $200 balance. This is a common error, is people will return something and then try to take the discount on the full $250, when really that's not okay, right? So here's what it looks like when they purchase it. we debit merchandise inventory, and we credit accounts payable. Then on June 3rd, we have this return. So when we do the return, all we're going to do is debit accounts payable, right? We don't owe that money anymore, and credit merchandise inventory because we're taking those items out of inventory, so we won't have that cost in our inventory. So then when we go to pay our bill, we only owe them $200, right? So you really have to look at your balance of your accounts payable account when you go to make the payment. So it was $250, then we debited a $50, so it's only $200. Just remember, whenever we pay for inventory, we're always debiting the full amount that we owe. So our accounts payable will go to zero. We won't owe that money anymore because we're paying it. And then we're going to credit cash, the amount of cash we have to pay, and credit merchandise inventory, the amount of the discount. So if you look at that transaction, the accounts payable is always going down by the full amount, and then the merchandise inventory and cash accounts will add up to equal the amount of cash we had to pay, plus the discount should equal the total accounts payable. Okay, another confusing point in this chapter, purchases and transportation costs. So the question is, who pays for the shipping of something when we buy it from a supplier, and who owns the goods while they're in transit? And really that comes down a lot of times to insurance companies. You know, if a big truck wrecks and it's carrying, 5 tons of Krispy Kreme donuts, whose insurance company has to pay for that, right? Like, is it the shipper or the receiver? And it's just sad if that many Krispy Kreme donuts get destroyed. You ever notice with Krispy Kreme that really their only good donut is their glazed? Like, all the rest are like, they're pretty good. They're like as good as like, a store-bought donut or something, but they're glazed, magical. All right. So we have these two terms, and they both use this FOB. One's called FOB shipping point. FOB stands for freight on board. And then the other is FOB destination. And so what we're saying is, if the shipping terms are FOB shipping point, then the ownership will transfer at the shipping point. And literally, when we say freight on board, it means when we load that freight on board of the carrier, whether it's a truck or a ship or whatever we're sending it on, upon the loading of that material on the carrier, it changes ownership and now it belongs to the buyer. And so with FOB shipping point, it becomes the property of the buyer at the shipping point, which means the buyer has to pay for the transportation costs. Why? Because it's their stuff. They got to pay the cost of getting it to themselves. Okay. And then, or there's FOB, freight on board, at the destination, meaning when that truck pulls up at the destination, it now becomes the property of the seller. Of the buyer at that point. So the whole time it was in transit, it was still the property of the seller. So under FOB destination, who pays for transportation costs? It's the seller. Why? Because it belonged to them. So this becomes important. One last concept here is when the buyer maintains or takes ownership at the shipping point, so using FOB shipping point, they're going to add transportation costs in to the cost of the inventory. So if I have to pay $1,000 to ship it to me, then the cost of that transportation I'm actually going to record by debiting merchandise inventory. So remember, merchandise inventory as an account represents what I paid. So the idea is not only what I paid to the supplier to sell it to me, but also the cost of getting it to me. All of that's going to roll together into the cost of the merchandise. On the other hand, if I'm a seller and I'm paying for it, so if I use FOB destination, then usually the seller will record transportation costs as a period cost, not as part of merchandise costs. So they're just going to debit delivery expense and credit cash. So that's kind of a lot in here. Just remember, FOB shipping point means that the ownership transfers at the shipping point, and so it belongs to the buyer while it's in transit. And so the buyer will pay for the transportation costs. An FOB destination means that ownership doesn't transfer until it gets to the destination, meaning it belonged to the seller while it was in transit, and the seller is going to pay for those costs.
I have a quick question.
Yeah.
That last is a good example. So like it's showing there in that last column that it's the buyer. So it's I mean, why is it called something different, like merchandise inventory and then delivery expense, even though it's kind of the same thing? It just depends on where, if it's the shipping point or the destination. I mean, is it
Right.
just because one's the buyer and one's the seller from that perspective? Sorry, I don't know. It
No,
just seems like isn't it the same thing? It's just because of the ownership that
right.
changes what account. Yeah, I don't know.
Yeah. So
Yeah.
the logic behind it is for a buyer, we're going to add those transportation costs into the cost of our inventory. From a seller's perspective, we're not going to add that into the cost of the inventory. Why they do that? I guess because one would be considered a selling expense that we just take as a period expense, whereas the other is, think about it, when we, as a buyer, we're adding this as an asset. And so what we want to do is say, how much did this asset cost me? But when we're a seller at that point, we're getting rid of the asset. And so it doesn't make sense to try to roll it into the cost of the asset and then expense the asset. Instead, we just record our cost of goods sold and record our delivery expense separately. And so that, honestly, that's just how it's developed and become kind of the norm. Could a person say, no, as a seller, I want to consider that all of that part of my cost of selling, a cost of goods sold? Yeah, but it's just not the standard way of doing it. But I think that's the logic is, as a buyer, we're trying to roll all costs into that asset as we do it. All right.
Thank you.
So our gross profit is all gross profit. Doesn't mean that it's disgusting. Okay. Unlike Krispy Kreme donuts, which are delicious, except for every once in a while. If you've ever seen that stand-up comedian who does the joke about the vegan donuts, well, that'd be a gross donut. But gross profit is just our sales minus our cost of goods sold. Okay. So net sales means our sales minus any sales discounts, minus any returns and allowances. That's what net sales is. Okay. Minus our cost of goods sold. That gives us gross profit. And then from gross profit, we would subtract all of our operating expenses, like our wages and our insurance and all of that. And that will give us our net profit. So the income statement you're going to see in this chapter is a little different than the one you've seen in the past, just because it adds this line of cost of goods sold and gross profit. All right, so let's switch gears. And now, instead of being the purchaser, we're the seller. Okay, so now we're selling stuff to people. Because, hey, that's what business is all about. So Zmart sells $1,000 of merchandise on credit, and the merchandise cost, it says, has a cost basis, means that it costs Zmart $300. So whenever we're the seller, then our entries we have to have two different entries, and this book uses the terms a revenue side journal entry and a cost side journal entry. All that we really have to recognize is we have to record the amount of money we receive from our customer, and that they're going to either owe us or that they paid us in cash. So that's the revenue side. And we have to record the cost, what we paid for the material, okay, or the inventory we're selling. So if we sell $1,000 worth of merchandise, our revenue side entry will look like this. We'll debit accounts receivable, $1,000. And we'll credit sales or sales revenue. There's to get to Anthony's point. Here, they're just calling it sales, and you're supposed to just know that that means revenue, right? But I will say commonly it'll be sales or sales revenue. But I've seen merchandise sales, or so they do change it. So there's our revenue side entry. Think about what this is saying. If you put it in plain English, I sold $1,000 worth of stuff to people. And they haven't paid me yet, so my accounts receivable increased by 1,000. We could also, if we sold it cash, our cash could be debited here 1,000, and our sales would be credited 1,000. So that's the revenue side entry. And then the cost side entry is what it cost us. So we're going to debit cost of goods sold, which is an expense, and then we're going to credit merchandise inventory to show that our inventory is going down by 300. And so if someone were to ask, well, what's the gross profit on this transaction? It would be our sales less our cost of goods sold. So they made $700 in gross profit on this transaction. I heard a microphone click. Did anybody have a question, or was it just? All right. Just like we have purchase discounts, we also can have sales discounts, meaning we offered the same kind of discount deal to the people we're selling to, and we've got to record those in our books. So again, so here we're using, again, this, what we would call a gross method, meaning we're recording the full amount we sold it for in our initial sales transaction. And then if the buyer pays with a discount, we're going to record it this way. So here, the buyer pays within the discount period. They get a 2% discount, which means our accounts receivable is going to go down by the full $1,000. So the customer doesn't owe us any money anymore, but they only had to pay us $980 in cash. So we're going to record sales discounts as $20. And then you'll see, like on our income statement, you'll have sales less sales discounts gives us our net sales. If the buyer pays after the discount period, then we're just going to debit cash and credit accounts receivable for the full amount because the buyer didn't get a discount. And again, these terms, 210 net 45 means 2% discount within 10 days, or they owe the full amount within 45 days. Sometimes we have sales with returns. And so a customer returns merchandise which sold for $15 and cost $9. So this one, it matters whether or not the goods are defective or not, because if the goods that they're returning to us are not defective, we're going to put them back into our inventory, right? So we can sell them again. If the goods they return are defective, then we got to deal with that, probably going back to our supplier, right? And saying, hey, you sold us defective goods. So anyway, all these little, again, what's so tough about this is in real life, you don't have to have it all in a word problem. You just sort of know what's happening because you understand the transaction. But in these problems, they always have to tell you all these details. So just like when we sold it, we had to have two entries, the cost or the revenue side and the cost side. We have to do the same thing for a return. So if the customer returns merchandise that we sold to them for $15, we're going to give them a sales return and allowance is what we're going to record that as. It's a debit of $15, and our cash going down is $15. So sales returns and allowances, and up here on this previous page, sales discounts. It looks kind of like they're an expense because we're debiting them, but actually, just so you know, they're a revenue account that reduces the revenue. So they're what's called a contra revenue account. Just like we learned about accumulated depreciation a little bit, and that's a contra asset account. Okay, so it's just a special type of account where we're recording these transactions that will have the effect of reducing our revenue. Okay, so we record the sales returns and allowances and the cash, and then we have to also record the cost. Since they're not defective, we're going to go ahead and add it back into our inventory. So we'll debit merchandise inventory, and we'll credit the cost of goods sold expense. All right, and sometimes if we're the seller, we will grant an allowance to somebody, okay, meaning that we're not getting the inventory back. So here we have a $40 of the merchandise that we sold is defective, but the buyer decides to keep it because Zmart offers a $10 price reduction. So again, if that happens, we just debit sales returns and allowance, credit cash, but we don't make any entry to inventory because the customer kept the stuff. All right, so here's a look at what a multi-step income statement looks like. These are the type of income statements you'll see from merchandising companies. They are similar, but have more detail than maybe the ones we've looked at so far. So you'll see that top line is sales. That's our revenue account. And then it'll be less sales discounts, less sales returns and allowances, and that will give us net sales. And then we'll have our cost of goods sold. And so our net sales minus our cost of goods sold will give us our gross profit. Okay. Gross profit, if you think about it, it means it's the money we're making before all of our operating expenses and stuff. So just from the sale of the goods. Then operating expenses are often broken out, not always, but often broken out into a couple sections: selling expenses and general, or sometimes they're just called administrative expenses. And our total operating, so now we have our gross profit minus our total operating expenses gives us our income from operations. And then we have this little area, which is other revenues and gains. So you can see like we made interest revenue. Here's where we'll record revenue that is not like part of our normal business operations. Like this business isn't in the business of lending money. So if they make $1,000 in interest, that's just other revenue. They sold a building. So again, they're not in the business of selling buildings. So they'd record that revenue down here in the other section. Interest expense. So then those will be netted out and we'll get our total other revenues and expenses. And so our income from operations plus these other revenues gives us our net income. So again, conceptually, it's the same idea as the other income statements you've seen, just with a lot more detail broken out, and specifically the addition of this returns and allowances, giving us net sales, and then the cost of goods sold expense and the gross profit. Those are, we haven't seen those with the service-based businesses we've been looking at.
Uh,
Yeah.
Can you please clarify why sales is credit is not debit?
So sales is credit. Its normal balance is a credit because it's a revenue account. Okay. And so if you think about it, if you have revenue, either you're gaining cash or you're gaining accounts receivable. One of those two assets always come together with revenue. And so since the increase to the asset is debited, then the increase to the revenue account has to be credited to make that a balanced transaction. There's a single step income statement closer to what we've seen before, where it just has the revenues, all of them lumped together up top, the expenses, and then the net income. And you know, it's like anything else in life, right? This seems simpler, so in some ways that's better, but with simpler you give up detail. And so you know, trade-offs, you know, we try to figure out what we need. A classified balance sheet will have a bit more detail than the balance sheets we've looked at, where it puts current assets, so it breaks assets into current assets and long-term or non-current assets. You'll see that inventory fits into the current assets section. And when we say current assets, what we mean is assets that are either cash already or readily convertible to cash within the next year, like inventory and accounts receivable. We expect to collect that and get cash, or sell our inventory and get cash, or that we expect to use up, like office supplies, all within the next year. So assets with a life of a year or less are considered current assets. And so the order we list assets in is that the most liquid, and liquid means cash or convertible to cash, are first, and then the less liquid assets are listed later on. And so you'll see, like in the next section of it, you would see like non-current or long-term assets, or sometimes they call it property, plant, and equipment, would be like buildings and land and equipment, stuff that's going to last a long time. Okay, so that's all I have for you. I know it seems like a lot. That's what's so rough about this class, and I teach it at multiple schools, and it's all the same everywhere. It's like the fire hose, you know, drinking method. You know, they're just going to pour information into you, and about the time you feel like I'm kind of understanding it, it's like now you have to do an exam on it. But it was just kind of starting to, you know. But anyway, it's kind of how life is, right? You think you're figuring something else out, and then you just get kicked in the head. Well, that was a really negative way of looking at it. What I mean is you get another opportunity to grow and learn. Is that better? Anyway. Okay, so it's 5:48. We have a little more time before that 1 hour, magical 1 hour shows up. Does anybody have a specific problem or question that they've been looking at that I could help with?
I just have a quick question.
Sure.
You were talking about how there was the detailed balance sheet and then the not really detailed balance sheet. Are there
Uh-huh.
specific times when somebody would choose to use one or the other, or can you give some examples of why they're two different versions or whatever?
Sure. So yeah, there's a couple reasons. One, the most common, honestly, is that just small businesses don't need a ridiculous amount of detail. They might only have a handful of balance sheet accounts, So like I own a storage business, and so like the only assets I have really are like my storage buildings, the land, maybe some equipment for working around the property. Um, and I have, so I mean, if I've only got 6 or 7 assets, it seems silly to try to separate all those out. So that's one reason. It's just smaller businesses often don't need that level of detail. Two is that there's sort of for publicly traded companies, there's legal requirements where they're required to list certain things on their balance sheet because they're publicly traded, and so they have to give more detail. But you'll like see, watch real quick. I'll go to like to so if we go to like Yahoo Finance, and let me just look up like Walmart or somebody that we've all heard of. Why are you so slow, Yahoo? There it goes. If I click on financials here, you'll see the way they do it is still like, here's an income statement. Let's look at their balance sheet. So you'll see like they give you this sort of like pretty not detailed. And like this is in thousands, so we would add 3 zeros. So that's big money, right? Walmart has total assets of $252,496,000,000. But then theirs are set up so you can like break this down and say, oh, now I see current assets and non-current assets. And then you can like split into that even more. Walmart I've always thought of as a cash-based business, but they've got $6 billion in receivables. So just try managing that. How many different people does it take to owe you $6 billion? Anyway, so my point, I guess, in showing you this is certain decision makers only need that broad level of knowledge. Others need more detail, and so it's pretty common now that we have things like HTML that we can provide something like this that allows both levels or even intermediate levels of detail to be given, depending on the user and their needs.
Cool. No, that helps. Thank you.
And Walmart's getting rich off us, guys. $571 billion in revenue this year. That's pretty good. Okay. Yeah.
I have a quick question. So just in this, we're talking about the growth. Is the growth just kind of a snapshot of the revenue of that transaction? Does that make sense what I just said?
Yeah, so you could look at a gross profit on a per transaction basis, or you could look at like the overall gross profit. So like right here on the screen, I've got Walmart up, right? And so their revenue, they call it minus their cost of revenue, gives their gross profit. So that's like a more macro view of it. Like all of our revenue minus all of our costs of earning that are this much. But like when I showed it before, we were just looking at the journal entry and we could say how much revenue came in on this end, on this transaction minus what was the cost of goods on that one. So yes, it can be that, but it could also be a more broader thing. More broader? I'm pretty sure that's good English. All right. Okay. Are we good for tonight?
I just have one more general question that's not necessarily for this week, but like kind of going forward, we have 2 more exams and then a final. It's way out, but is the final cumulative for like the whole semester, and then the next 2 exams are just for specific chapters?
Yes, so that's exactly right, and I'm sorry to be the bearer of that news, but yeah, so the next 2 exams will be like these first 2 where they've covered a specific set of chapters, and then the final is cumulative. I will tell you, past experience is that people tend to score on the final right really close, plus or minus say 5% of how they score, like how they average on the exams. And so it's not like it's so hard being cumulative that it's killing people. It's about the same. And also don't be discouraged by that if you haven't been happy with your exam scores on the first 2, is people are able to as that improvement comes, it shows on the final as well. Okay, well, can I get a volunteer for a closing prayer?
I'll say it.
Okay, thanks.
Our Father in heaven, we're grateful for this day and for the opportunity to be able to gather together and to ask questions and to be able to be taught from Brother Fox. And we're grateful for the time that he puts into our class. And we ask you to please help us to be able to understand this information and to make sense of it and to become comfortable with it. And we say these things in the name of Jesus Christ. Amen.
Amen. Hey, in this week's intro, I shared a talk by Elder Holland. And I know everybody's like crazy busy at this stage, and maybe you've already, it was something I pulled out of this week's Come Follow Me, and it was a devotional when he was speaking there at BYU. If you get a chance, it's so full of like hope for the future. It was a good thing for me this week. So if you're like, hey, I have an extra 30 minutes, you can listen to him on double speed. It only takes 15, but then it loses some of the effect, some of the gravitas, right? Anyway, check it out if you have time. It's pretty good. Anyway, have a great night, everybody, and thank you.
Thank you.
Thanks.